Hey, so we can start and then let's see who else joins. I'm going to share my screen and then we can go through the slides and then I will take you to the platform and then we can actually look at the real market and then try and set up some trades. I will take you through from the basics of buying and selling options and then how do we create spreads and then how do we trade them and how do we manage those spreads. That's the whole idea of this webinar. Let me share my screen and then let's kick off here. See if I'm sharing the right screen.
All right, I'm back.
Okay, great. Yeah. So I
Okay,
was just gonna
great. Yeah.
say,
So this.
oh, is that me? Okay. Can you hear me okay?
Yeah, I hear you all right. Are you hearing
I
something like a
I
headphone?
can hear you. Yeah, sure. Let's see who else joins. But let me take you through the basics of buying and selling options and then the strategies that I have been running successfully for the last, I would say maybe 4 years, 4 or 5 years, because I started doing this about 8 or 9 years ago, and then the first few years were not really profitable or successful for me, and then I started changing the strategy and I started learning a little bit more, and that's how that's how I created the spread strategy, and then I started trading not just the underlying equity options or ETF options, but futures options, and I found that there's a lot more benefit in trading futures options versus anything else because of the leverage that we get, less buying power that is involved, and then you can get a good bang for your buck there in the futures options market. Generally in the futures market, but then futures options even better because we're not putting down it as much capital um, as we are in the equity and the ETF markets um, compared to the futures market. Now, I this year I've traded small in my account. Let me just take you through quickly, like why should you listen to this webinar? Why me? I mean, I've been trading successfully, profitable this year. I was profitable last couple of years, but it's a small profit. Yes, I get it, but I was trading. I'm trading a very small account. My account size is like 3,500. And at any given time, I don't go above 1,500 to $2,000 invested capital. So, and that's how I recommend everyone to do as well. But we'll go through the slides and I'll show you exactly how I do it, basically. So the idea here is to not learn how to buy options. Buying options is basically the value that I'm trying to provide here is not to learn how to buy options. Buying options, anyone can do. They can just click a button and then buy the option. And then there's a 30% chance that option will become profitable. Whereas when you sell the option, you are on the other side of the market and you have a 70% chance that you will be successful in that trade. And I'll show you exactly how those probabilities work, where to look for those numbers, and how to set up these trades, which are high probability, high success rate spreads, and different types of strategies. Now, also one other question that I normally get is like, why spreads? Now, spreads because we as a retail trader, I have a small account, and in order to protect that account and continue growing it, I cannot go unlimited risk with these strategies because I have to make sure that my downside is protected. So therefore, we have I'm getting some chat messages. Let me take a look. Sorry, just 1 second. How to get into the chat stuff. Oh, you don't, you might be on your end. Okay, I hear now. Okay, so everyone can hear me, right? Just give me a thumbs up on the chat. I'm gonna continue going, going through the webinar. Sorry. So yeah, where were we? Option selling. So how do we do this basically? The first thing is we trade small. Like I said, no more than 2 to 7%, or I should say 3 to 5% should be your sweet spot. That's what it is for me. For any given trade or any allocation there. So let's say you are trading 3 different strategies in 3 different tickers. Each strategy should only contain 2 to 5% of your account size, of your maximum account size. That's our go-to. We don't trade more than that. We trade with higher probability of success. I will show you how to do that. Liquidity, also king here in this market. To learn options trading successfully, a lot of you basically started this journey like I did. Started this journey by buying options, and I was never profitable. Yes, I will make a lot of money in one trade, and I will lose a lot in the other. Then I will make some money in the other trade, next trade, and then I will lose some in the one after that. So it was always like a 50-50 chance. However, when I started selling options, everything turned around, and then I started making profit consistently, I would say. It's a waiting game, it's a patience game, and that's what I want to, just throw it out there, that you will not become a millionaire overnight, but you will learn a skill or really good skill that you can go out in the market and then continue doing it by yourself. Anyway, the fourth most important thing that we look at is duration of the trade. We don't trade small durations. So our duration is usually 40 to 50 days out. Why? Because we collect good amount of premium when we go out in time. And then when things go wrong, which they usually do, I mean, I have 3 trades right now, and 2 of them, actually one of them has gone really bad right now on me. It's the 30-year bond trade that I am long, and the bond market has been falling. I don't know if you're watching the markets. I can show you where the bond markets are, and this is my paper trading account, so don't think that this is the real account. But look at this chart here. The bond trade, the bond market is down now. I am a contrarian, so I went long this market somewhere at this level. So my short strike was sitting at 112. Oh, it still currently is, but this is the adjustment that I've made. And I will show you how to adjust and how to set up these trades. But just showing you the markets that things can go wrong, and it has gone wrong for me in this market. Overall, I have 3 trades on, and 2 of them are profitable, but one of them is like underwater, which is this one. Anyway, let's go into the platform, and I'll show you the long calls, the long side of the market, and then the short side, and then all the probability of profits from there. And then from there on, I'll show you the short sides, and then we will move into the spreads market. So on the spread section, we will cover credit spreads, and then iron condors, and then I will cover covered calls. So these are like some of my really favorite strategies on the risk protected side, meaning you are buying some protection, you're buying the wings to keep your capital preserved. You're not selling the market naked short here. So long call and long puts, you must have seen this thousands of times. This is what the P&L diagram looks like, but it's only a 50-50 chance. Now, let me just take you through this example here. So let's pick up Apple, right? Let me bring up Apple here. And then let's go in because our duration is usually 50 days. So I'm going to open up this cycle, and then and then which one to buy? That's the first question. Like, well, I will never buy an out of the money option in these markets, even less probability of profit. Now look at this column here, probability of being in the money. This is this column tells you what is your chance of making money in this trade if you go long the option. When I say long the option, you just go out of the money. So Apple is trading around 220, 225. You're going on the call side, you're going out of the money, and then you're buying a 20 delta call at 240. Now you're hoping that between now and 49 days, this thing will go above 240 and then stay above 240. Now it can, yes, but there are a lot of other things in play here. Let me show you what other Greeks are in play here, because volatility is a very big factor in the pricing of these options. So look at this. Look at these Greeks here. Let me open up the Greek section. So I'm collecting 20 delta. That's fine. So for each dollar move, you will collect $20. Yes. But look at the Vega here. Vega is the volatility part. Now, if the volatility goes up, yes, you make money. But if it goes down, you will not make money. You will lose $23 a day. In theta, you are getting negative theta here, meaning every single day that passes and the market doesn't move or however much it moves, you will lose $6 a day. And volatility is the most important part here. If it goes down from here, meaning the market sells off, you are not only losing on the delta side, but you're losing on the Vega side as well, because because you're long volatility, every long option buyer is long the volatility, meaning only if the vol goes up, they make money. But think about it. You on one hand, you have collected some positive delta. On the other hand, you're also collecting positive Vega. Positive delta will help you when the market goes up, fine. But when vol goes down, and when market goes up, vol usually goes down, right? Volatility does not go up. Volatility goes up when the market goes down. So when it goes down, you're getting hit on both sides. You're getting hit on delta, and then yes, you will make some money on the on the Vega side because you have positive vol here. So always keep these Greeks in mind. Theta is a big number. As it gets closer to expiration, the theta will kill your account or kill this trade, because the theta will just balloon up. Right now it's at $5 or $6 a day, but when it gets closer to expiration, this number will be around $30 to $35 per day that you will lose on this contract. Anyway, this is the long call side of things. If you were to buy an out of the money, let's say an at the money long put, I'm actually showing you the at the money probabilities here, because for me, if I were to ever buy it, a long option, I will only buy an at the money option, because when we sell the options, we sell out of money, and that's how we have a better percentage of making money, better chance of making money. But when we buy the option, we only buy at the money options, because those have the best chance of like getting in the money for us to make money as a long holder. Now look at the probability of profit here. This trade, it usually has a 60. If this is the underlying asset, it first needs to go down by almost $10 here, so $9.35. So stock needs to move down by $9.35 for you to break even, because you're paying a debit. You're paying a debit here. And only after that, you will start making money. If the stock keeps going down within that time period, a lot of things have to happen for you to make money on the long side. Now, let me show you the short side of things. If you were to sell an option, let's say you're selling a short put. Normally, we sell a 70 delta. So this column here, let me bring up a marker. I'm not sure if you can see everything that I have that I'm pointing at. So the vanishing one here, this one. So usually we sell at this level, 17. When we buy, like I said, we buy at 50 because these guys have the best, probability of being in the money. So as soon as we sell, we right click and we sell. I'm just showing you a simple short put here, not a spread, just a naked option. Just trying to show you the probability of profit that is in our favor. Now look, the shaded part here is where the expected move is. Always make sure the dates are lined up. So when you set slices, the break-even date here is 12/21, and then my date on top here is also the same thing. So look at the shaded part. Now what this is telling me is like from now, wherever the stock price is at 223, the stock price is expected to move within this shaded range. And if it does that, if it does, move in this shaded range, we will make money because we are sitting right above that where the shaded range region starts. Yes, we will make less money. So this is the risk reward ratio in selling versus buying. In buying, you can put down $1 and make $3. But how often? Only 30% of the time. If you're buying an out of the money option, which we never do. Let's say you buy the at the money option, you only are doing it 50% of the time. When we sell the option, which we always do on the out of the money side, so I'm selling an out of the money option, I will make small amounts of profit more often. So my account will not be depleted. I will live another day to trade because we trade small. We don't trade naked options. Anyway, this is the short put side. Now, if I were to sell a short call side, I will look at the calls. I will look at the call chain, which will be again 49 days out. Perfect. This is our sweet spot. And then I will sell there is no 17 to 18 delta here, but I will sell the 21 delta, which is fine. And I will collect whatever credit that it's giving me. So on the single side, I'm selling a call option here. I just need to fix this by default thing. It should just only show me one. Again, look at this. Your probability of profit, which is this number on top. Look at this number, 78%. So you have a 78% pop here, meaning probability of profit in this trade for you is 78%. So there's a 78% chance that you will make money on this profit. When I say make money, that the underlying will stay within this expected range, or it will go down a little bit, and then you will still make money. Yes, you will make less money. Like how much money will you make? Roughly $2. Fine, that's not bad. But you will make these $2 more often versus buying a call option and making $300. When I say $2, this is $200 actually. But when you buy an option, you can make, I don't know, $10, maybe $1,000. But how often? And what is the probability of that thing happening? Not very high, I would say. And therefore we sell that, and that is the reason why we sell options, but we sell options in a protected way, meaning we protect the downside. We don't let these things hurt us too much. We have management techniques. When the trade goes bad on us, we know how to roll it. We know how to adjust the strikes a little bit, and we know how to trade small but keep trading often. With different markets. So so this was just a plain long call, long put, short call, short put explanation. If you have any questions, just keep putting it in the chat, or come off mute and just talk to me, and I'll go through the answers. But let me take you through two different examples here. So one, I want to talk about why we trade futures options and the spreads in those markets, and then why don't we trade the index options. So I'm going to pull up an SPX index, right? This is the index that the futures actually are made up of. So I'm going 48 days out. Perfect. That's what I want. That's the sweet spot. 45 to 50 or 40 to 50 days. That's a good amount of that. This should give us a good amount of credit. But again, if I go down to my 17 delta spot, right, it's these are the strikes. So I have to pick, let's say we pick 53.40 strike. and we sell a short put spread. Now, how do we do that? This is how we do it. We right click on that 17 delta point, which is here, sell, and we sell a vertical. Now, again, here's another question though. Why are we selling a short put and not a short call? The market, as a contrarian trader, the market has been down recently. Yes, last few days it has been driving, sideways, and then it's down quite a bit recently. So on the put side, you will get more premium, and therefore we sell the put options. Now, the right click, and then let's do a sell vertical. And this, make sure you don't go above 2 contracts at a time. I normally just start with one, and if I see an opportunity, I go in it with another, right? So here's in the index options, our width of the strikes will be about 10 points. So I'm selling at 53. Sorry, what am I doing here? I'm selling at 53.40, yes, and I'm buying at 53.30. So I'm collecting $1.10 here in this trade. Now, this chart doesn't look accurate to me, and that could be because the markets are off right now. But oh yeah, here I need to change the date to 12/20. So always make sure these dates line up. So here's a chart. Now you're collecting $110, perfect, right? And your max loss is $890 because it's $1,000 trade. It's the width of the strikes is like 10 points, and those 10 points mean $1,000 in SPX terms. Now, if you confirm and send, you look at the amount of buying power that you're putting down, $890. So these brokers will collect your max loss amount, the amount that you are actually could lose in this trade, the max loss. Not just a small amount, but the max loss. That's the amount that they will collect from your account for you to initiate this trade. In order to make $110, you're putting down $890. So not a good ROI. Now, let me show you another ticker which does the exact same thing, but with 3 times less money. It's called S&P 500 Futures. And the ticker is /ES, right? And they're basically exact replica of each other. The futures market is made up of the spot market, which is the cash market, which is the SPX market. So in terms of the mechanics of these products, they're exactly the same. But the futures market will give you a better ROI. And why would I say that? Now, let's say we do the same thing. We go 17 delta here, 53.80. But in the futures market, in order to collect the exact same amount of dollars, we have to go 20 points wide. It's just how the products are made, because the futures market have a 50 times multiplier on the index. So therefore, you have to go twice as wide. So I'm buying it at 53.60. Okay, great. This is almost similar amount of credit. Let's take a look. 12.21. Something is off. This chart is not perfect, but here, look, I'm collecting the same amount of credit. If I go confirm and send, I'm collecting $112. Oh, my buying power is 0 right now because I think I already have a position, but I don't think I should be showing that. Anyway, what I'm trying to show here is in order to collect the exact same amount of dollars, if I didn't have a position on, I think I was doing a test trade before, and I currently have when you have a position on, they don't charge you more money. But I don't know how much more buying power will be used, because I already have an iron condor here sitting here in /ES as a test trade. But if this was a real trade, this number would have been $300 here in buying power. So you are collecting same amount of cash, but you are paying, you're putting down 3 times less money. Now, 2 things to consider. Commissions are slightly higher here in futures options, fine. SPX options a little bit low, that's okay. And the other thing is the index options are cash settled, meaning if you ever get assigned, it will be cash settled. It's in the futures options, we never go close to expiration. So we never run into this problem of getting assigned. But if you were ever assigned, you will be given a futures contract when your option is assigned. So those are the two differences, but it's the exact same product. You collect the same amount of cash, and then you put down less money. So these are the things I want to cover with you. Now, anyway, I do have a position on in ES, which I put on, I don't know, maybe a while ago, and I forgot about it. And today when I came back to my paper trading account, it is still there. But let me take you through the position that I currently have. And let's go through that example. Like, how do we manage these credit spreads? Once we have them on, how do we manage them? Once we have them on, let's say we start with the short put side of things. Let's say, and then it starts going bad on us. Actually, let me just create a new one. So I'm going to sell a new credit spread here. My position is sitting in this AM settled. Okay, there's another reason why we trade AM settled. I wanted to show you, like, look at the open interest and volume column. These are the columns that I normally have in my view, because this is how we figure out what the liquidity in these products are. Volume and open interest so low in the AM settled, in the non-AM settled one, right? Look how low these numbers are. Well, comparatively. So now go into the other cycle, this one, and then see here in thousands. The last two columns here, these numbers are in thousands, right? And therefore that's why we have this. We have the position here. Anyway, that position is completely separate. We can open up a new one. Well, I will not be able to open up a position, but I can show you how it looks because the markets are closed. So I cannot send the trade in. Otherwise, I would have. Okay, so we're doing the same thing, 53.40, 53.20. 17 delta is our sweet spot. Let's analyze this trade. And then let's go here. It's all perfect. The chart looks a little bit off to me. It should not be that much of a shaded region, but again, it could be because the markets are off. Anyway, so this is how we start a trade. Let's say we were selling a put spread. This is how we would start a trade. And then let's say a few days in, you get tested on your strikes, meaning you were long the market, but then the market started going down. Now, what do? So you convert this into a iron condor. And that's the reason why I have this iron condor sitting here, because I probably started with a short put or the short call side, but then I converted this into an iron condor by selling the other side. Now, how would we sell the other side? Let's say we sold a short put and then the market went down on us. And now the market is sitting around here somewhere. Our strikes are sitting somewhere here, 30 delta. So in order to neutralize the delta, I'm going to go on the call side and I'm going to find the 30 delta strike, which would be around here somewhere, 58.90, and then I'm going to sell that side, 59.20 actually. So I'm going to sell a vertical, $20 wide, 20 points wide, and I'm going to bring that into our trade. So the more premium you collect, the better your break-even chances are, your break-even points are. So you keep improving your break-even points when you collect more premium on these trades. So our first line of defense is sell the other side, meaning if you were short put, we will sell a short call, we will collect more credit, and then we will sit on it. What's the next step? So let's say we have an iron condor now. Now what happens? Well, in that case, we will see how much more duration do we have left in this expiration cycle. If we have about 25 to 30 days left, we will sit here. If we have less than that, if we have, let's say, 20 to 18 days left, we will try and move the whole spread out into the next cycle, meaning we will close the spread out in this cycle. If it's sitting right in the middle, I will not touch it because there's a possibility that it can go either way. But if it goes if you have less days left. Then we have to move the spread out. So meaning we have to close one side, we have to open up the other, well, close this expiration cycle, open up another one, which is totally fine. We can move the spreads out. So a couple of things to consider, like where to start your next cycle. Now, if it's really testing on the put side, I'm going to sell a further out of the money put spread to start afresh in the new cycle. And trust me, it probably is very confusing right now, but I haven't really rolled or managed or adjusted a trade more than once or twice max this year. I do a lot of adjustments, but I should do a lot of adjustments, but in the index options, like these ones, we start with the short put side because we don't sell calls because the market is so bullish. And then we move the spread out into another cycle, and then we sit there. We collect more premium, and then we collect more theta. And this happens in all the other products that we trade. So we trade. let me take you through the actual tickers that we have. So these are the tickers we trade. S&P 500 options, futures options, NASDAQ, Russell, the three main indices. And I have the spread width here as well, like exactly how much, how wide should you be on those spreads. Then we trade the crude oil market, currencies, and metals. Gold, silver you can, but silver is a big product for small accounts like us. It's a bigger product. And then bonds. In the interest rate markets, I prefer trading bonds versus notes. Notes are the 10-year treasuries, and bonds are like 30 years. I understand the 30-year market's better. And again, like I said, it's only 1 point out. Each point is like $15.625. So we collect about 9 to 10 points in each trade when we sell. And then we buy back that spread, we buy it back for 3 or 4 points, meaning we make about $100 in each trade. We put down 300 to 350 to max 400 in that trade. Each market that I've listed here doesn't require you to put down more than 350 to initiate the trade, maybe 400 for indices when the volatility is really high. When do we sell these spreads? When the volatility is high, we look at implied vol. We look at a couple of different factors, meaning we look at what the implied vol is. So right now it's pretty high because the market was down yesterday. So it's got an inverse relationship with the market, meaning when the vol goes down, the market goes up. When the market goes down, the vol goes up. So always remember when S&P 500 gets sold off, the volatility will always jump. And that's what has happened here recently. If you were to draw a line on the average number, the average for the year has been 13, right? But recently the vol jumped up because the market has been really volatile. It's been going sideways and then down. So that's what we have. These are the things that we look at. We've covered the spreads. I've covered the long and short options with you. Now let me go through the covered call side of things, meaning if you hold some stock positions, which we normally do as retail small traders. Let's say if I have 100 Apple stock, how will I create more income out of that position? Now for that, let's say if I buy Apple, let me trade Apple here. So I'm going to buy 100 Apple stock. I cannot buy it right now, but I'm going to just put it in the Analyze tab so we can take a look. So again, when you buy an asset, you just have a 50-50 chance. But the good thing is that it doesn't expire, so you can just sit on it. But in order to buy this position, you need to put down $11,000, 50% of whatever the dollar amount is, because they give you 50% margin, right? Okay, so assume that you have 100 Apple stock in your account. Now, what do you do with it? And it's also important to know what's your cost basis on that stock. Let's say you buy it at the market, which is $222. Now, if that was me, if I have a position in Apple, 100 stock, and I bought it at 220 or 225, I will go on the call side. And again, so the sweet spot is 17 to 20 delta. So sell that option. So to be on the safe side, I'm going to sell 245, right? Let's say not a vertical. That's the wrong one. You have to sell a naked option, a naked call option, a single call option here. Now remember, each call option, one option controls 100 shares. So when you do this, they do not require more money from you, from your account. And you can check that here. So if you confirm and send this trade, there's a little bit of because it doesn't know that you have the stock here. So if you did have the stock, the buying power effect will be zero. You can actually create a cover call strategy here by in think or swim by selling it here. It's called covered stock, but I don't really know exactly how to set it up. All I know is like how to set up the individual stock line and then individual option line, because that's how I've been doing it in my account. So that's how I know. I don't know exactly how this covered stock button works. Anyway, if this is how the position was. Now let's say you have a Apple stock position. By selling a cover call, this will cap your profits, meaning at this strike at 245, after that, you will not make any money in this position. But that's a good thing because your stock went up from 225 or 220, wherever you bought it, to 245. So it's already up 25 points. For 100 stock, that is 100 times 25. Plus, you also keep the $1.20 that you collect on this trade at this strike. This lowers your cost basis, basically. How to adjust this? Now, there is a little bit of a downside risk in the strategy, because let's say you sold this at 245 and then the stock gets called away at 245. Now, anything after 245 or after your break-even point at this level, you have capped your profits, right? Fine. But then if it hits that strike, or if it hits that level or that price, then that stock will get called away from you. Now, once it gets called away, are you comfortable giving it away at 245? If you are, then perfect. It's the best scenario for you. You normally carry positive delta in this strategy. Now, a couple of things that you should know about this cover call strategy is like you are reducing a little bit of your risk because you're cutting down your long stock delta, which is 100 delta on the long stock side. If I were to like just look at the 100 stock line, look, I just collect 100 delta here, and then I don't collect any other Greeks because it's not an option. Now, as soon as you go in and then you short some of the call delta, meaning you are short the market, if you select this side, you are now short 85 delta overall because you're shorting 15 delta through the call option. So when you do that, you reduce your delta, but you bring in other Greeks in the position that you are collecting theta, and then you are short volatility, meaning only if the vol goes down, you make money. But if the vol goes up, you will lose money. So even though cover call is a good strategy, what I normally do is wherever I buy the stock, I will sell 20 to 25, not even delta. I would still go out 17, 20 delta, and I will sell it there. And if it gets breached, if it gets too close to me, I normally roll the call side out into another expiration cycle. If I want to keep hold of my stock position. If you don't, then you can let it go. It's the best case scenario, meaning you made money on the profit on the call side, and then you made money on the stock side. That's the best case scenario. So we've covered the three different strategies. I've shown you how to set it up. Some other things, some housekeeping stuff. We do look at correlations, like what's the correlation in the market. Now this one is last 10 years correlation, and you can clearly see that, I don't know if this is big enough for you, but you can clearly see that these indices are really highly correlated, right? So SPY, Qs, and then where's the Russell? I have the Russell here as well somewhere. Yeah, all of these are like really highly correlated. So Russell, Qs, and SPY. So if you have a position in one, that means theoretically you have a position in the other as well. So don't create positions in all three of them at the same time, unless there's a big price move in each of them and there's an opportunity there. I do not ever sell a similar position in all three of these indices. Taking a position in one is enough because they're all correlated, right? Highly correlated. So you gotta be careful at that point. Euros, small correlation, so I like that. Currency, you should always have currency positions in your account. Crude oil, again, a good ticker. Gold, very low correlation with other markets, but gold this year has been through the roof. Normally we sell call in the gold product, but this year I have stayed away from it because look at the gold product here this year. It has just gone through the roof. It's even up more than S&P 500, all the way to the right. Top right, and that's where it has been all year. 27.45 is the number. Okay, what else? So I've given these. I will send these slides later, and you can go through them later again as well. I just wanted to make sure that we go through the practical side more, meaning how to actually do this, which buttons to click. That's more important to me. I can talk for an hour and then I can go away, but then you will be like, okay, so what did I achieve in this? That's what I want to go through. Which buttons to actually click and how to set it up. So my advice will be open up a paper trading account. Start putting these strategies on. Figure out like what works for you. Like spreads, yes. I mean that's what works for me. Maybe that works for you too. But always remember your max risk, like your risk appetite. It cannot be like anyone else. It cannot be like me. It cannot be like a third person. You cannot put more than 10% of your account in. This is a very extreme scenario. You should be sitting around here. 5 to 7% should be your max. And the way that I've shown you these trades, the way they set up, you are putting down $300 to $350, meaning if you have a $5,000 account, you are within 5 to 7% of your account. And that's what I've been doing all year. Don't ever spend more than 50% of your account overall. So overall, when you take a look at your accounts, at your positions, you should not have spent more than 50% of your actual dollar amount in your overall portfolio. So let's say you have $100,000 account, right? You cannot spend more than $50,000 to $60,000 at any given time. You have to stay within that range because then when the market provides you the opportunity, you should have some dry powder, and you should trade small, one contract size, size each, index each underlying asset, and then see how it goes. I mean, maybe the buying option has not worked, or it has worked fine, so the selling side will not work for you, or you don't want to do it, or you don't want to try it. But if the buying side hasn't worked, give this thing a try by testing it out on the platform. You can easily get a paper trading account with all margin capabilities. The entire account value, I mean. So let's say you have a $50,000 account. You at any given time, you should only be invested 25,000. You cannot invest the whole 50,000 at any given time in these strategies. Yes, you can go out and buy your favorite positions, whatever. But when you're trading short options, you got to keep some dry powder. Keep some dry powder so that when the market opportunity comes along, you can sell more spreads, you can adjust, you can, and my advice will be to start trading spreads rather than short naked options. Strangles is one of my favorite strategies, but my account cannot handle it all the time. Because in order to put a strangle position on in ES options, I need to have at least $3,000 to $5,000. My max account is 3 to 5 right now. So I would not start with strangles. I would start with spreads. The way I'm showing you here is you can easily put 3 to 4 positions on at any given time with a $5,000 account. And you can learn the trade, learn the skill, and keep rolling it, keep adjusting it. Now, here's some Greeks that I put on. Take a look at this in the slides. And remember, for long calls and long options, you collect negative theta. That's the worst part of it, meaning you lose money every single day on that theta side. And And on the short side, that theta is on your side. It's in your favor. So you collect more money there with a higher pop. We've already talked about liquidity. I've shown you how to look for liquidity. Open interest and volume is the main thing in the options market. Always look for high open interest, high volume, at least in thousands. So the number has to be higher hundreds or in thousands for sure. Otherwise, do not touch that product because you will lose a lot in the bid-ask spread. I'm going to discuss bid-ask spread in a separate day, but bid-ask means, let's say you want to get in right now and then get out right away, you will pay that spread. If you buy it at $5, they will not, and the market does not move, and you still want to sell it at $5, they will not buy it back from you at $5. They will buy it back for you, from you at $4. So the bid-ask spread is $1, right? And in some cases, we see big, wide bid-ask spreads. Market orders. Okay, I don't use market orders. I use limit orders. So every time I put a position on, I select my own price, whatever the market price is. I try to get a little bit more out of it, but if I cannot, I will take the market price. So, but I start with a limit order. I don't start with a market order. Here's some info on market versus limit, like when should you actually use it? If you really want to get out of the trade, you will take the market all day long. I would do the same. But if I have time, I'm not really panicking, and I am not really in a hurry right now, I will sit on the trade and let the market come to me. Some other housekeeping stuff here. Which brokers to use and how to actually get started. Now, at least I hope I've given you enough information on how to actually get started here. There are other ways that we can connect and you can keep in touch with whatever I do in this market. I mean, I have posted a really good video recently on how I trade credit spreads in S&P 500 futures. Go take a look on the YouTube channel. I don't know how you can get on the channel, but I have the link here. The channel is called The Long Short Idea. The handle is Long Short Idea. Just take a look there. Maybe you will like it. It's almost 1 hour long. But I've tried to cover every single thing in there, meaning how I adjust, what do I look at, and then how I read the option chain and how I read the payoff diagrams before I get in. So take a look there, and then we have a Discord channel that I run. There's not much happening there, but we are trying to build content there so people can learn and stay connected and then talk to each other and then build a community around there. So this is the presentation. I hope I've given you enough info to at least get started. This will not make you, an expert trader in this market. I'm not even an expert. I'm a guide. You should look at me as a guide because I'm somebody who's been doing it for a while. So I can guide you through this landscape, and then we can put some trades on together. But start learning the selling option, on the short side of options. It's been my bread and butter for a long time, and it's been really helpful, and I should say profitable for me. So if you have any questions, I will take those questions right now. Otherwise,
yeah. So currently I have a hard time really understanding the Greeks, especially with that Vega. How you explained that that Vega may be like bad if you are on the sell side and the volatility goes up. I think you said like that's bad for you. Was that correct? Is that what you said?
So when you buy an option, let's say you buy a call or a put option, you will be long Vega, meaning volatility is positive in that position. So only if volatility goes up, you will make money on the Vega side, on the vol side. But when you are short the option, when you're selling the option, you are short Vega. And the reason why we sell options at high volatility is because volatility is mean reverting. Now, let me also show you like what do I mean by mean reverting. Let me take you back in on the platform one more time. I just want to show you the VIX chart. Now, let's say bring up VIX for the year. Now look how volatility stays within its mean level. This is its average level. 14, 15, 17, 18. Now this VIX is basically based on S&P 500 30-day out options. Fine. We don't need to go into that. But why do we think that selling vol is good and is kind of like an edge for us? Is because vol is always mean reverting. So it goes up, it comes down. Whenever it goes up, it comes down. Whenever it goes up, it comes down to its mean level. So when we know that this thing will come down, whenever it pops up, we sell that option. So we are short Vega, and when it goes down, we make money on that down ride. I hope that helps. Basically, when you buy, yeah,
that does help. So how do you know what that mean level is? I mean, I see you have an implied volatility chart there, but
yeah,
I don't necessarily know how to read that. And
yeah, sure. Okay, so
like the
that's a
top
great
chart,
point.
the VIX that you have there has that mean line in the middle, but the implied volatility chart doesn't have a nice little mean line to
Uh,
gauge.
no, so that's a great question. So we can look at both of these. Now, implied volatility is something we look at on individual assets, not on VIX itself. For VIX, we look at the VIX futures or the VIX cash product. This is the VIX cash product, and if you look into /VX, that's the VIX futures product. /VX also has options, and if you want to trade volatility options, you can do in this product too. Anyway, this is what we look at. So both of these products have their mean reverting level, meaning when volatility stays very stagnant, which it has done through this year, most of this year. So if you look at from the start of this year, well, actually, this chart goes back one whole year. So starting of the year is here around this mark, and then if you look at up to here and into August or something, the volatility has stayed around 13-14%. The question is, what's the mean level? This is the mean level. If you look at the history of VEX for the last ever since it started in 93, the 13-14% is the mean level of VEX. So whenever it goes above that, it hits 19-20, that means volatility is high, and it will come down to its mean reverting level. When it goes above 30, 40, 50, that's a really high volatility environment, and that's what we look for to sell vol and sell options. So whenever vol, so you should just keep one number in mind. VIX has been around 13, 14, 15%, 16 as its mean level for the last so many years. But when it goes up to 20, 22, that's a high vol environment, and we should be selling options.
Okay, so you would use the VIX just as a overall uh, gauge on the volatility for that specific market. You said the S&P, I think.
Yeah.
But when we're talking individual products, like you mentioned, um, I guess because my biggest issue is when I go and sell an option,
Mm-hmm.
and let's say the option gets filled like a short time later, um, the the premium on that actually goes up. And so I kind of like missed out on, if I would have held on a little later, I would have got a better premium. And I think something might be going on with the volatility there that might be creating that. So I'm trying to figure out what's a good way for me to see that using that implied volatility little meter there.
Yeah, sure. So again, each product has its own implied volatility chart. So you cannot compare Apple's implied volatility with S&P 500s because S&P 500 vol works differently to individual stocks. Individual stocks will have higher vol than an index vol. Index meaning S&P 500 or NASDAQ. In the individual names, you can look at the implied volatility chart like I'm looking at it right now, and I can just draw a hypothetical line here in the middle and say, well, to me, the average for this year looks like it's 26, 27, but last couple of days, it went up to like 34, and that would have been a good time to get in and sell the option. And look, how nicely this implied volatility has come down. When it does that, you will make money on the short option side. But implied volatility is one of the factors that we look at to initiate the trade. It's not the only thing. So the way I trade is I look at implied vol, and then I look at the market extremes, like price movements. So like I said, I'm a contrarian trader. At this point, when it's gone down so much, I mean, I would have sold a put side. I would have sold a put spread here, somewhere around this mark. My strikes would have been around 210. And as a risk reversal trade, I would have expected this market to go up. On the price extreme side, you will always collect more premium, meaning there's more juice available whichever way the market goes. So if the market moves up, the juice is on the call side. And if the market goes down and implied volatility is up, the juice is on the put side. Now, I was looking at a research recently that if you look at the last 50 years of history, the best strategy in the options market has been to sell the short put. Always. Whenever the market goes down, if you have sold a short put, if you've kept selling the short put, you would have made a lot of money. It's been the best performing strategy in this market, which tells me that 70% of the investors out there, investors, traders, hedgers, speculators, whoever, they buy products in this market. They buy these assets. So there are 70% of the people actually buy the market. Only about 20 to 30% people are on the short side of the market. So what does that mean for us? That means the market has a positive drift, meaning it will go up more than it will come down, obviously, right? To me, 70% of the time it goes up, then it comes down. So short puts has been the go-to trade for me this year. Now, like I said, it can go bad too. Now, my ZB trade, my 30-year bond trade is going bad right now, but I'm not panicking because my strikes are like further out of money and I know how to adjust it. So if it keeps coming close to my short put, I will keep moving the spread out in time and collect more premium on it.
You mentioned that you don't hold your position all the way till expiration. Is there some uh, kind of measure that lets you know when to get out of the trade? I mean, if all is going well.
Yeah. I mean, if all is going well, I collect 30 to 40% of the max profit and I get out. And then I redeploy that capital somewhere else. Again, like I said, if it's all working out, 30 to 40% of max profit. So let's say if I collected $125 in the ES trade, I will get out of that trade when I have $75 in my pocket. So $65 to $75 after commission, that will be $60 to $70, and I will redeploy that capital again somewhere else. But if it's going bad on you, when do you roll? You roll in the last 15 to 20 days because as short sellers, the gamma side of things is really strong and intense in the last 15 to 20 days. So you have to either move out in expiration, in duration, and collect more time and more premium, or you need to do something in this cycle. I don't normally stay in the cycle when there's less than 15 to 20 days left. So get in at 45 to 50, get out at, when there's 15 to 20 days left.
Is there any kind of risk to holding it when the trade is going well?
When the trade's going well, no, not really. Well, the only risk that I think of is, like I said, short gamma. So as short sellers, we carry some short gamma in these positions. In the last few days, let's say 10 days are left, you will see the P&L in your account. If the trade goes bad on you, the P&L will move a lot because short gamma will move that delta around a lot. And I just don't like that, unbalanced delta versus gamma in the position. So if it goes well, I take the profit and I run, redeploy somewhere else. There's no, for me, there's not enough reward left in that spread. For another $50, I will not risk, the 75 that I've already collected. I'm not going to risk another, for the remaining 50. I'm not going to risk the 75 that I've collected already. So that's the theory.
Okay. I got you.
Yeah. It takes time to learn these trades, how to adjust. And like I said, when I started selling strangles right away, and my account could not handle it, so I got panicked. And then I started using the spreads more, and the spreads have worked out better because I know how to adjust, I know how to roll, and then going in, I know my max loss. And I also know that if the market moves against me quite a bit, then I'm not going to completely like deplete my account. Because with naked options, you can actually do that. You can lose a lot of money. So
Cool. Thank you.
great. Thanks for the questions, Henry, and thank you everyone for joining. I will send the slides out, and then let's see I'm still thinking about my next topic. What to do the webinar on, maybe continue this whole theme again on the spread side of things, or maybe I can introduce a new strategy on the short side. But still thinking about that. So yeah, thank you for joining and spending the time today here, everyone.
And in the future, I'd be curious to know about some longer term positions. I know you say you do typically about 50 days or so, but I'm kind of curious about maybe like some year-long type
The leaps,
positions. So that
leaps
could be a
strategy.
future topic or
Yeah,
some. Yeah, because my thought was that maybe I can somehow, especially on the sell side, maybe have like a long-term capital gain as opposed to the
yeah,
short-term capital gains from these short positions. So
that is true. Okay, yeah, I mean that's a great topic to discuss as well. So I'm gonna note it down, and then maybe in the next few weeks I will create something out of that, the lead section. Sure.
thank you. Thank you.
Cool thing.
All right, cool.
Th- Thank you.
Have a good one.
You too. Bye.